I've just combined all of my old workplace pensions into a SIPP. It's now so much easier to manage, and I finally get to choose exactly what I invest in. So in this video, I'm going to walk you through exactly what I invested into and my reasons for doing so. I chose to combine them into a Hargreaves Lansdown SIPP, and I'll get onto the reasons why I chose that platform a little bit later in the video. Just for context, I know that I've got at least 20 years before I can access this account, so I've got a reasonably long time horizon. I can afford to ride out volatility. And for that long-term growth, I know that I want to be all in equity right now. By picking individual stocks, I do recognize that I do take on a little bit more risk. And the simple approach for most people in pensions would just be picking a global ETF. But I do like having a bit more of an active approach, and I have to be comfortable with taking on that risk and the potential downfalls that come with that. So I've got just over a third of the portfolio in individual holdings, and that's split between 6 different stocks. And I prefer to have a top-down approach. That means I look at the macro picture first, look at what themes I might feel that are going to outperform in the long run, and then drill down into individual companies. And for this, I picked out 3 different investment themes: defense, AI, and nuclear. I have done a full video on these investment themes, breaking down exactly why I've chosen them, but I'll give you a brief overview now. Defense, I think, is a really good long-term play, and unfortunately I feel like we have seen an increase in conflicts all around the world. We may not have actually had an increase in conflicts, we just see more about it in the news and social media. But we have seen governments massively increase their defense budgets in recent years, especially in Europe, and I can't see that stopping anytime soon. Defense also appears to be an industry that is reasonably well protected. So even if a country's economy is struggling, if they've made defense a priority, then it's likely to maintain that sector. So if we do see a correction or even a crash across the global stock market, although those defense stocks won't be totally protected, they will still likely see a little bit of a sell-off. They won't see quite as much sell-off as some of the more speculative stocks. That doesn't mean they're not volatile though. So for defense, I've chosen BAE Systems and RTX, what used to be known as Raytheon. They're 2 massive players from the UK and the US respectively, and you could argue that this is probably a little bit late to the party. They are quite expensive stocks to invest into right now, but their profit outlooks have surged, and they've both got massive order backlogs. So still do feel like there's a long runway here. But with defense, it's such a long-term play, so even though it does feel quite expensive right now, I do feel that they've got a lot more growth potential even in the near future. And if it does dip, I can afford to ride out that volatility because I've got the time horizon to do so. And then we've got AI, the thing that everyone's been talking about. And when I look at this investment theme, I'm confident that this is going to be the next big technology. I think it's going to be as big as the dawn of the internet. But I didn't want to focus on the big players like Nvidia and Microsoft. I always compare this to similar to like a gold rush. And there's a saying that in a gold rush, the biggest fortunes goes to the ones that are selling the shovels. So in this case, it would be the ones that are making the data centers, the ones that are producing the chips, and the ones that are producing the power. So when I looked at this investment theme, I wanted to focus on the infrastructure that enables AI rather than the specific AI companies themselves. For the AI theme, I've chosen Equinix and ASML Holding. Equinix is the world's largest data center real estate investment trust, and this is 100% my picks and shovels play for AI. The need for data center capacity is only going in one direction, so I feel like having a real estate investment trust is a bit more of a stable play. You get the reoccurring revenues because a lot of them are long-term leases, and I think it's only going to expand further. So I think this is a really good, again, long-term play. And then we've got ASML. This is a Dutch company, and they specialize in making lithography machines. These are the ones that are needed to actually manufacture the computer chips, and they have a near monopoly in this space. So when Nvidia or Google need new AI chips, they ultimately rely on ASML machines. And then we've got nuclear, and this slightly follows on from the AI theme because data centers right now are making up around 2% of world demand of electricity. And I think that's only going to increase. Whether it's the electrification of transport, whether it's crypto mining or AI itself, I think that need for a clean and reliable source of energy is only going to increase. And that's where I think nuclear has an ever-increasing role to play in this. So I've looked at companies that are designing the reactors, but I've also looked at uranium as well because that's the main fuel source for the reactors. And there's also a dual purpose here because not only is it used for energy creation, but also overlaps with the defense theme where it's also used in nuclear weapons as well. I chose Rolls-Royce because the UK government's just selected the Rolls-Royce SMR as their preferred SMR technology. That's those small modular reactors that can be built on site and at much quicker pace. And Rolls-Royce also has a trifecta exposure because it produces jet engines both for civilian and military aircraft, and now it's also an emerging nuclear reactor developer. And then Cameco is one of the world's largest and most established uranium producers. So this is based on the theory of having more nuclear reactors is going to require more uranium, which in turn is going to increase the price of it. So those are my 6 stocks, and I think I have to recognize how volatile this is going to be. But I think the beauty of having a SIPP is that I can't touch it for such a long period of time. I can't withdraw that money. I can obviously make tweaks and changes, But the more changes I make, I think the more mistakes I'm going to make, and actually it will cost me more money in the long run. But you can see I only started this a few weeks ago and BAE Systems is already down 12%. I mentioned that it didn't feel a great time to invest at what felt like the peak of the market, but within a few weeks, that could easily recover, and that's how volatile some of these stocks are. So I just have to accept that. And just before we move on to the ETF part of the portfolio, I just wanted to let you know that I've recently started a free weekly Investing Insights newsletter. It's every Monday morning and it's a 2-minute read. I'm also in the process of creating a free investing community for UK investors. So to be the first to hear when it goes live, sign up using the link down below. With the ETFs, I knew that I wanted to have the larger portion of my portfolio just invested into a passive ETF. And I could have kept it really simple and just picked one global ETF. That would have been the most straightforward approach. But I wanted to be able to change some of the weightings of different countries. I was specifically looking at the US, and we've seen them massively outperform the rest of the world over the past 15 years. And I feel that I slightly want to underweight the US going forward and put some of that weight elsewhere. So by creating a 6-fund portfolio, I can cover all of the world, but I can choose which weightings I want in which regions. I've got a full video on the channel going over how to create your own DIY global portfolio. But the main premise was I wanted to reduce my US exposure and spread that elsewhere. I reduced my US exposure to about 32%. It's still going to be the largest weighting in the portfolio, but a lot less than around the 60% in your typical global ETF. I've then overweighted all the other regions, but I've specifically focused on emerging markets and the UK market. The emerging markets fund has countries like China, India, Brazil, and I think they have lagged the rest of the market in the last 10 to 15 years. But now I think it's their time to shine. So I've put a 25% weighting on emerging markets. I then increased both Japan and the UK to around a 10% weighting. That's only a slight increase for Japan, a slightly larger one for the UK. I do feel the UK market is slightly more undervalued, especially compared to countries like the US. We've seen the FTSE 100 hit new all-time highs in the past few weeks, but I do feel that it's lagged slightly and this is a little bit of a catch-up. The FTSE 100 is also very globally diversified, so this is no reflection on the UK economy, and I think that's something that a lot of people confuse. They see the UK economy being in such a bad state, and then are confused why the FTSE 100 is hitting new all-time highs. And it's because of the global diversification nature of the largest 100 companies in the UK. With the developed Europe excluding UK, I've kept it roughly the same as ever so slightly increased from the 11% in a global ETF up to about 12% in this portfolio. Then we've developed Asia excluding Japan, so that's countries like Australia and South Korea if you're using a FTSE index. I've increased that from about 4% in a typical global ETF to about 11% in this portfolio. You may wonder why I've separated both Japan and the UK markets. Those are two of the largest countries in the global stock market. So by excluding the UK from Europe and Japan from developed Asia, gives you a little bit more freedom and flexibility to play around with those weightings. And I picked North America over picking a typical S&P 500 ETF, which some people do, because I also wanted some exposure to Canada as well. And obviously North America covers both. We'll have to see how these go. And at some point I may have to reweight, but there is a little bit of a risk with reweighting, because if you're having to reweight, it's because one of them has outperformed the weighting that you selected for it. And if you were to reweight, bring it back to what you originally selected, what you're essentially then doing there is reducing the holding that's actually outperformed, and that could continue outperforming. So sometimes you do have to let these run for a bit. I think some people fall into the trap of reweighting every month, for example. I think for this being such a long-term project, I'm not going to reweight for at least a year. I want to see what happens to the global stock market in general. Is there going to be a correction or even a crash? How does that affect each region, and how does each region recover from that? I will also at some point start to contribute into the SIPP, and then there's a decision about how to split the contributions. I think I'll most likely keep the single stocks as they are. I've got all of the dividends being reinvested, so they'll slowly tick over, and then I'll just split it between the ETFs. And then finally, why did I choose Hargreaves Lansdown for a SIPP? Because to be honest, it's not the cheapest platform. First of all, I needed a platform that had access to stocks, ETFs, and funds, because I did initially look at something like Invest Engine, which is totally free, but they only offer ETFs, so I knew I couldn't use that. In terms of annual charges for Hargreaves Lansdown, they charge a 0.45% on ETFs and shares, but it is capped at £200 per year. So it means once you hit over about £44,000, that percentage will come down. So my idea is that as the portfolio grows, that percentage will only keep coming down. In terms of dealing charges, they do charge £12 for buying and selling, which is not ideal, especially when there's so many other options out there which are either cheaper or even free. But really, I think as this continues to grow in size, I've just got to make sure I don't make small transactions. So you'll see here my smallest holding is the Japan ETF, which is about £3,800. So obviously the larger the transaction, that £12 is going to make a smaller percentage of the total investment. So as long as it continues to grow and I just don't make smaller transactions, I think that will be fine in that sense. And then it's got the size and the reputation, and it's just what I'm used to. I've used the platform for a long period of time. And while the website's not the greatest, I tend to do most of my research off platform, and then I'm literally just using the website or the app to execute the transaction. But some of the others I looked at were Fidelity, AJ Bell, and Interactive Investor. And there's probably more out there as well. But that's my full portfolio breakdown of my SIPP right now. I'll leave the 2 links to the videos. The first one going over the single stocks and the investment themes, and then also the breakdown of how to create a DIY global portfolio. Let me know your thoughts down below in the comments. Hope you found that useful, and I'll catch you in the next one.